Today, we're going to talk about rates. Is the Fed going to actually cut any of these rates? How this is affecting commercial real estate, and then what's happening across the U.S. residential real estate market.
All right. Anton Stentner podcast number 56. What are we talking about today?
How many cuts is the Fed going to do this year?
Mm-hmm.
And I feel like we might have to open the book over there, and we might have to take bets, and we want the listeners to put in the comments, how many are we going to get?
If you're not familiar, we're talking about the Federal Reserve. They basically control the interest rate at the core, and it was going down, down, down forever, went up, went down, and then guess what? They jacked them up, and the question is, are they going to lower them? Because right now, mortgage interest rates are crazy. They're still at 7, right?
Yep, 7%.
Now, the interest rate they set isn't that high, but it's influenced by that rate. And we've been waiting for rates to be cut for a while now, like almost a year and a half-ish.
I would say we've been waiting
almost
6 months.
Oh, 6 months. Oh, for it to be cut.
For it to be cut.
Because it's been going up.
Yeah. So my question to you, Benji, is how many rate cuts do we get in 2024?
Yeah, simple.
Hey, this is why I want to take bets.
I believe it's 2 or less.
Ooh, I'm with you. Today, I'm actually going to bet it's 1.
That's different from even last week.
It's different, and it's because it's getting worse.
Okay, well, explain why it was more last week and what you mean by getting worse. Because I'm actually intrigued as well, because you're like, Benji, don't worry, they're going to lower the rates. They have to.
I felt like they had to, and I know we all know they still will have to. What keeps happening, though, is our economic data keeps coming in, and it keeps performing much better than anticipated. Job numbers are beating, but inflation is still high. Core PCE is still high, and the economy is chugging right along. So they can't cut, nor should they cut. And so the Fed came out and they said, hey, we expect, and that was just recently at the FOMC meeting, they expect 3 rate cuts this year. And we're like, okay, we're still on target for 3.
That was last week-ish.
That was 2 weeks ago, basically. Then and they also said, hey, we've probably reached peak rates because we've gone through our whole tightening cycle and we feel like we're there. And then Jerome Powell this morning goes and talks to the Stanford Business School. And if you really listen to his words, and then you listen to the other 3 Fed presidents that came out this week, you go, wait a second. They're not saying 3. That's what I heard this morning. That's why I said, hey, we should take bets, because I only like to take bets when I feel like I can win. So originally, and you can go look this up, it's called the CME Fed Watch tool. The market was pricing in as many as 7 rate cuts at one point, 6 rate cuts.
For this year?
For this year.
Whoa.
This was at the very beginning of the year, okay? Now, if you go and look at the CME Fed Watch tool, they basically have put it to where no cuts in May, and then only 2 cuts this year, and a maybe for December. So the market right now is pricing in 2 and a shmaybe. What we've known, and what you and I have talked about, and what all of our listeners know, is that the market has been horribly wrong and overly optimistic about all of their predictions on rate cuts. And the Fed has been telegraphing their playbook, and they've been telling us higher for longer. We have to wait on the totality of the data. Well, let's talk about the totality of the data. So, since our last one, the PCE came out, and PCE is the Fed's favorite measure, and PCE core, so minus the volatile food and energy, came out at 2.5% for February and 2.8% for core, which is well above the Fed's target of 2%. So Jerome Powell goes to Stanford, and he says, and I'm going to quote him, "On inflation, it's too soon to say whether the recent readings represent more than just a bump. In other words, we're waiting for more data to come out." And then he said, "We do not expect that we will it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably towards 2%. Given the strength of the economy and the progress on inflation so far, we have to let the incoming data guide us towards our policy decisions. So he literally just said this morning, hey, by the way, we're going to wait. We have to wait for more data because PCE was showing, and so it bumped up a little onto the hot side that we're probably not there yet. Reactions, thoughts?
Well, let me just lay it down a little bit for maybe someone that's like their head spinning. The Federal Reserve raises or lowers interest rates based off of the data that shows us the health of the economy, basically, right? Or where inflation is at. Their job is to try to keep inflation tamed down. And why this is significant that they might not lower as many times, or maybe even only just one, is because the reason they would lower the interest rates is because inflation has come down, but the economy needs some help. So let's lower interest rates. Well, we just heard that the economy is doing a little bit better than we thought. And inflation, not only sticky, it like ticked up a little bit.
It's sticky and
so
it's hotter.
They don't have any good reason to lower interest rates. The conspiracy theory or the hypothetical was, hey, they might still lower interest rates because of politics, right? Because Biden's like, I need some more votes. Let's like do something good for the people. Well, Papa Powell, we think, is a more disciplined, federal chair than that. And so my thought is this. Why we're even talking about interest rates or interest rates from the Fed is because we're worried about interest rates for mortgages, right? For investment loans, because whether you're going into your first home as a first-time home buyer, or you're buying residential properties as an investment, or we're going to talk about commercial, that interest rate just determines what you can afford. And if they do not lower interest rates, or they only do it even one, that means that the prices that we're seeing right now are going to still be expensive at the end of the year in terms of your mortgage payment. Yes. Now, the good thing, I think, like if let's do like the bright side, if they don't lower interest rates, house prices, commercial real estate may hold steady.
It'll hold tighter
and not go up.
Bingo.
Right? Because this is the catch-22 of all of this. We want lower interest rates because we want a lower payment. Well, when you lower the interest rates, the price of the homes gets higher because we have low inventory and there's more competition. So, we're just like saying the same things, but we're now kind of seeing where we're going to be, which as an investor or even just a regular home buyer kind of helps you to navigate what you might want to do the next, 6 to 12 months.
100%. So for us as investors, and we're looking into the future, this means it's a pinch on cash flow. We've got to get higher cap rates. As buyers, it means payments are higher and less affordable. It also means relief is not coming, which it means it will continue to pinch the banking sector, the real estate sector, the lending sector, the auto industry, any sort of industry that is rate sensitive will continue to be pinched by this. But see, the Fed's mandate is strong economy and low inflation. If the economy is strong and inflation is not down, then they have to keep going. And then they can use their tools if they break it. So the Fed doesn't usually significantly lower rates until they actually start breaking something. Nothing is breaking in the economy, therefore they don't have to do it. I love how you brought up the politics too, because he said that he wanted to reiterate the Fed's independence and their lack of political bias because these elections are heating up. And I think this is going to become kind of nasty. So I'm going to quote what he said. He said, "Our analysis is free of any personal or political bias in service to the public. We do not always get it right, and no one does. But our decisions will reflect our painstaking assessment of what is best for our economy in the medium and the longer term, and nothing else." He went on to say, what's also happening from a political perspective is people are trying to force mission creep onto the Federal Reserve. In other words, them to expand their mission, to do more things.
He said that?
He said that.
Really?
And
so he's calling people out.
He's calling people out. He's quietly calling people out for trying to shove more things into the Fed when the Fed should just stay neutral and biased as much as they can. So what was specifically happening was they were trying to force the Fed into being involved in climate change. And I quote again, "We are not, nor do we seek to be, climate policy makers." And so what I love is he's pushing back here because he's getting political pressure, especially because of the election, because of other things, though, like climate change and banking regulation, and he's fighting them off. When you look at this, so now we're going to talk about the totality of the data. PCE came in hot. The market says 2, maybe 1. I'm being pessimistic today. Yesterday was a long day. My body battery was 13 when I went to bed last night. Your Garmin tracks that. And I was like, okay, I'm basically dead. So my energy's not super high. So that could be part of it. But also you had 3 Fed presidents come out and use their mouth this week to talk. So 2 of them were bullish and 1 of them was bearish. So Mester said 3 rate cuts. Daily, 3 rate cuts. Bostic, 1. So if you look at that and kind of, think about, well, the average of that is still,
3,
2.5.
Yeah.
There's a good bet you'll get your 2. I'm just being pessimistic and saying 1. And what we have to be thinking about when I say, hey, we're only getting 1 rate cut, is I want our people thinking about how this affects real estate. Number 1. Number 2, I want you thinking about what opportunities this then creates in real estate. How it affects real estate is it pinches banks further, pinches their margins longer, because the banks have been pricing in that the rate cuts were coming. So part of their margin has been compressing. And as their margin compresses, they have less money. Plus, they're having to pay depositors higher rates of return. So now they're going, oh my goodness, maybe we don't want to issue as many loans. So lending is going to become more difficult over the next quarter. So over the next quarter, assume it's going to be more difficult to purchase a home, to buy an investment property, to refinance something like that, because they don't want to give up that margin. And I'm specifically talking more about local banks, regional banks, those kind of community style banks, than I am talking about walking into somewhere like Chase. The local banks and those regional banks are being pinched by this, and that's what you need to know. When we flip it over and go, well, what's the opportunity because they're being pinched? The opportunity is that drop in liquidity means they may not be likely to refi an investor as quickly. They're going to push for the note to come due. I received an email earlier today from a gentleman who all he does is multifamily. And it showed an analysis here in Western Washington and Eastern Washington. For those of you that don't know, we're in the greater Seattle metro, and Washington State is basically divided in half by the Cascades. It's like almost 2 different worlds. On the east side of the Cascades, more rural, more high desert. On the west side of the Cascades, more urban, lower land, lots of more rain. Both of those, they looked at the cap rates for multifamily in 2023 versus 2024. The cap rates are still rising. And they were showing throughout Washington State, depending on where you were looking in what city, there was anywhere between a 0.5 point to a full point rise in cap rates.
Tell me again, is cap rates going up good or bad?
If cap rates are going, well, it depends. If you're the seller and a cap rate going up, it's bad. It means your value is going down because you have to provide a higher performing asset to the buyer. If you're a buyer, it means you're buying a better asset with better cash flow and a higher performance or a higher yield. So like everything, it depends. We just ran through a multifamily in downtown Seattle, and because cap rates have risen, the multifamily value was exactly the same as it was in 2021.
Wow.
So that person's losing 2 years worth of value. just because of this very expensive debt and what's forcing on cap rates.
So, I mean, that rolls us into the next topic, which is commercial real estate. Let's talk about that.
So it's really crazy right now. This came out during the Great Recession, this idea of extend and pretend. And what extend and pretend means is the individual during the Great Recession was behind on their housing payment, but Bank of America or Fannie Mae or Freddie Mac was not foreclosing on the property. They were just allowing it to sit there. They were extending the note and just pretending instead of foreclosing, because there was already such a tsunami of foreclosures happening. This is starting in commercial real estate right now. The actual extend and pretend is playing out right in front of us. So there is nearly 20% of the outstanding debt for commercial real estate and multifamily that is going to mature in 2024. It's $929 billion, aka almost a trillion dollars. That's going to require refinancing or property sales. And let's, just so everyone's on the same page, in case you have not been listening, is that commercial real estate prices as of this morning, now this is an aggregate across the US, they're down 21% from their peak in 2022, and they're down 35% in the office category specifically since 2022. So you look at this and you go, there's $1 trillion worth of debt coming, and values are down anywhere between 21 to 35%.
And interest rates are up.
And I've got to give them a higher performing cap rate.
So you have to make this thing that probably was already working on all cylinders work even more just to get interest rate that's good, which might still not be good enough, and your property is worth less. So the banks, especially local regional banks who are into commercial, are less likely to refinance you and lend to you. So you're kind of like shit out of luck.
You're stuck in a corner. And so there was an article in the Wall Street Journal talking about mortgage bonds, mortgage-backed securities, and they were relating it to the office meltdown. So they said 26% of the $36 billion in office loans that matured in fourth quarter of 2023 were paid off. Wait a second, flip that around. That means if there was 4 loans maturing, 1 of them got paid off, 3 of them went into extend and pretend in fourth quarter. So they're just kicking the can down the field. But what we just said is the Federal Reserve is going to keep the rates higher for longer because PCE came in hot and we're getting ready to go into an election, and the market's now betting there's less cuts coming, and these banks are getting their margin squeezed. There are more than 1,000 commercial mortgage-backed security office loans now with special servicers. So there's a minimum of 1,000 loans that are in some type of default. Okay, now when I say that, mentally everyone immediately goes to the Great Recession. So we got to go there real quick. In the Great Recession, you have to understand that housing was over-leveraged, under-collateralized, and then it was sprayed and prayed to the globe. Here's what I mean by that. Housing was leveraged at 100% to 105% of value. Not all of it was, but a lot of it could be. Today, housing specifically has a lot of equity. The residential mortgage-backed securities, we packaged that debt up, we sold them to everyone. So that's why when the dominoes started falling, it became systemic, became cancerous, and took out the globe and the US. This problem is a lot more isolated. The majority of this debt is held by local and regional banks. Also, commercial debt, generally speaking, the investors are putting 20%, 25%, 35% down. So when we talked about office specifically, and we said office is down 35%, if the bank was to take it back, they actually may just be breaking completely even because the investors put 35% in there. Now, the investors would be totally wiped out, okay? They would be gone, but a lot of these banks will be made whole. This is why it's not going to turn into the commercial real estate tsunami because of the level equity that's present.
Because in 2008, for the residential, people didn't put any money down versus with commercial, it's always been the practice to get a lot more down payment.
The average down payment is like 30%.
Yeah.
And so what this will do is it'll wipe out, so people in syndications, it'll wipe out those LPs, those limited partners. It'll wipe out the GPs too, for that matter. But these banks should be whole. So we're going to play another little game. What city in the United States has the largest commercial debt? And that is coming up for refinancing in 2024.
San Francisco.
San Francisco's number 2. You did better than the last one. And then, but San Francisco is approximately 25% of the biggest player. So where's the majority of this debt coming through in the U.S.?
Is it in the Bay Area still?
Manhattan.
I was going to say that. Damn it.
Okay, Manhattan number 1, San Francisco number 2, Chicago 3, LA 4, Houston, Long Island, Sunnyvale, Burbank, Philadelphia, and Santa Clara. Okay, now realize this will also wipe out some property developers too. Moral of the story is what this really means is some of these cities are going to get hit harder. So Manhattan, for example, will get hit harder than other areas, which will affect regional and local banks there more. And so the thing to be paying attention to is these bigger cities, as more debt becomes due, it actually may create massive opportunity for you as an investor. Whether you're a single investor or an investment group, as it hits Manhattan, Houston, Texas, San Francisco, Los Angeles, Chicago, there's going to be deals that are going to hit the market because they're going to have to. Because even though they're doing some extend and pretend today, they will not extend and pretend on all of it.
Can I ask you a question about Seattle?
Yeah.
All right. So I'm an investor in the Seattle metro area. I want to get into commercial real estate, or maybe I'm an investor that's already been investing. What's your thoughts about what's happening in the Seattle area and what's going to happen in the next 6 to 12 months in relation to commercial real estate?
In relation to commercial real estate here throughout the Seattle metro, the office space in the downtown metros of like Seattle and Bellevue is definitely beat up. Amazon is the largest occupier of office space, and they have vacated a ton of it. I would avoid office space unless you can buy it at such a significant discount that you can basically put a safety net underneath you to grab you from that risk. You're seeing cap rates on multifamily rise in Seattle. You're seeing still warehouse in our area. I mean, it's just warehouse is great. You're not really seeing any problems with that. And that's probably because Amazon is right here. Let's be blunt. They've taken up every warehouse everywhere. So that and manufacturing inside of warehouses has been very good, very stable. Your really large retail complexes, they've been having problems. I'm talking the B-class malls, the C-class malls, and you're starting to see them get repurposed. So what I would be looking for is a deal where someone's note is coming due and they have to sell, and you are there when they have to sell. That's going to be your biggest opportunity, regardless of what specific sector it's in or specific location. I know 4 people specifically in the next 24 months that are going to have to sell townhomes, multifamily, and some office retail, and another one is mixed use because their notes are coming due. And financially, their commercial stuff does not make sense today. And that's like personal friend network. Going just outside the personal friend network, I was called, I went on an appointment, we chatted with this individual with a large multifamily that's been underperforming due to lack of good management. Any commercial asset, if you do not manage it well, the value starts to go down. That is going to require a cash-in refinance of $1.8 million. That's a lot to swallow for an investor to go shove $2 million into something because that note is actually due right now. So you have a choice. Got to come up with the 1.8. I can sell it, or I can bring in an additional partner. That's it. Maybe the bank will extend and pretend for 90 days, 6 months, but they're not going to extend and pretend forever. And so that's what we're seeing. Your deals are in solving someone else's problem. And it's been like that since the dawn of time in real estate. We've always made the most money solving someone else's problem. It just so happens that commercial real estate is down between 21 to 35%. So you're going to get an unnatural reward solving a big boy and a big girl problem. But that also requires some big boy and big girl money.
There you go. Solving problems. So thank you very much for the advice. I'm going to go solve some problems. All right. So the next topic today is how are rates affecting the national housing market? Let's take a quick look at the last quarter.
Yeah. So we're kind of looking at all these things together. The Fed hasn't been lowering rates. The Fed has said higher for longer. Housing is still doing surprisingly well, and it's outperformed what the public thought it would do and what the crash bros thought it would do. And
explain is doing fairly well. Break that down. What does that actually mean?
Yeah. What I mean when I say doing fairly well is that we did peak out at an annual run rate of about 6.6 million real estate transactions when rates were really low. As the Federal Reserve basically went from 0 to 5.25 to 5.5, and then mortgage rates went from 3 to essentially 7, and they went all the way up to just a little bit over 8, but they're about 7 today, is we went down to just under 4 million transactions, and it bounced right back up. And it didn't go below 3.8 when interest rates were over 8. So surprisingly well means the base level of real estate transactions just from life events here throughout the whole US is around 4 million deals a year. And that's because of, diapers, diamonds, death, divorce, the new job, things like that. When you get married or a life event or you've got to relocate or unfortunately someone passes away or divorce, that's a have-to real estate transaction. We've shown the base level of transactions is about 4 million with that, which is surprisingly higher than most people thought. That's why I say that. And then what's also super surprising is when rates went to 8 and then they settled in around 7, is that prices did not crash. Well, why did prices not crash? Prices didn't crash because during the Great Recession, there's this massive gap in the building of homes, and you can find this right on the Federal Reserve's website. You can see 2008, 9, 10, 11, and 12. The graph was going like this, and then there's this just giant iceberg V right out of the graph. That lack of supply, which is, we talked about it on one of the previous episodes, which is about 2.8 million units on average, however you measure it, is keeping prices higher. So what's happened is home sales have started to rebound. So as rates have basically been sitting stable for a few months now, home sales have started to rebound. Inventory has been rising. Home prices have been rising in some metros, down in some. So they're still down slightly for the whole US. But when you look at pending sales and how quickly they're going into pending and inventory rising, you know that home prices are actually getting ready to rise right after that. What's funny is the crash bros, they like to read this data wrong. They go, listings are up 18%, therefore the market's going to be flooded. But what you see is pendings are up 23%. So even though as new inventory is reaching the U.S. housing market, it's being gobbled up by the buyer, regardless of interest rates right behind it. So that demand has been sufficient to gobble up the existing inventory, even though it's rising slightly.
People are literally eating the high interest rates because they have no choice.
They're eating it in their payment. And then what they're also doing is they're eating it at the grocery store because inflation has eaten their buying power. We talked about that. If you're not subscribed, please subscribe. You will hear all of these things. But we talked about this before. Trueflation talked about how since January of 2020, the average American's purchasing power has been eroded by 24%. So we've had a massive just change in that purchasing power. We know mortgages are expensive. We know the market's tight. This next piece of data blew my mind. Cash buyers are higher right now. Okay. When all this, so the economy was ripping, we did all the stimmy money. So a lot of US citizens put a lot of cash in the bank. So according to NAR, 33% of all buyers in first quarter were cash. It has not been that high since 2014. They also, what they do is they look over and they go, it's a 7% mortgage. I'm maybe only earning 3 to 5% on my cash. I'd rather just pay cash. And when rates come down, I'm going to refinance later. So in summary, the U.S. housing market, expect slightly higher inventory. Expect the market to continue heating up. Expect the buyer demand to be eating that and prices to rise slightly. So if I was to give, hey, what's Anton's price prediction for the U.S., I would say right now we're going to have a 3 to a 5% price appreciation in 2024. That's what the data is showing us at the end of Q1. And it's not crashing. And there's nothing to show it crashing. So the Fed is most likely going to stay a little bit higher for longer, which means these rates are going to be around for longer. So don't wait if you're waiting for the rates to come down, because if we do that, what happens is this. As rates come down, all buyers, all investors feel more comfortable. So everyone tries to purchase more. That's just more demand. And we know the U.S. housing market is in a low inventory environment. So waiting is not in your favor today if you can afford it.